Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my really good friend, Matt Burk. Hi, Matt.
Hey, Mike.
Thank you kindly for coming to the podcast. You were a guest before, and you're coming again. And we just come back from the Best Ever Conference. And VeriVest had a great event there called the Pitch Fest, sponsoring a great number of folks that came forward with deals. And VeriVest launched a fund builder. So before we dive into that, anything new and exciting in the world of Matt Burk?
Yeah, I'm just dealing with all the same things in the world that everybody else is dealing with. So, one day at a time. But wife's good, kids are good. Life is good, and plenty of challenges to navigate. But wouldn't have it any other way.
Appreciate that. And for the audience, I forgot to introduce you. You are the CEO of Fairway America LLC, as well as the VeriVest LLC. And the VeriVest is a fund administrator. We are working with VeriVest, been working for many years, and same thing with Fairway. All right, so let's dive into Fund Builder. So VeriVest just launched Fund Builder. Could you tell folks a little bit about the tool? It's a very powerful tool. It's a great tool for folks to build new documentation and structure for new syndications and funds.
Yeah, I think as you know, Mike, and for the benefit of the listeners, really what kind of founded VeriVest, what got it started, was our advisory business of helping small and emerging real estate managers try to set up their own vehicles to launch real estate offerings. And so I think historically people have always gone to lawyers, which is, of course, good and necessary. But the value we've tried to bring from the perspective of a longtime fund manager is bringing advice and guidance around all of the issues that somebody's going to face in the totality of running a real estate asset-based investment fund. Right, and there is the legal angle, which is important, but there's also the accounting angle. There's the origination angle, acquisitions. There's asset management. There's capital raising. There's investor relations, right? And they all affect everything else. So, in 2012 or 13, we started doing advisory work for people, and it really was an outflow of people coming to me asking me about, hey, Matt, I know you've done a bunch of funds, and I'm thinking about setting up a fund. What do you think of this? What do you think of that? How should I do this? What are these issues, right? And that gave rise to a business that in the last 10 years, we've done several hundred engagements where we've played kind of a lead advisory role to these real estate managers to set up their own pooled investment fund that in my judgment, just has a far greater chance of success if you set it up properly in the first place. So that's been kind of the core of our business model. That gave rise to our administration business, which is doing the back office tracking and accounting of pooled investment funds on behalf of those managers, right? But the advisory came before the admin. Right, the admin was an outflow of the advisory. So what Fund Builder then is, to come back to that, is we've now, 10 years later, we're bringing technology to the process of the creation and the advisory work of those entities on the front end to help people streamline it, make it less expensive, less time consuming, easier to get started, and just overall allow them, a greater chance of success by using the tools that we provide. So, Mike, we still have an advisory component to our business, but the Fund Builder piece allows us to do it much quicker because it automates that process.
Yeah, that's a great overview. And from my own personal experience, receiving the help of your advisory business, having set up our multiple of our funds through your advisory, I can tell you that the process was slower and expensive then. I remember writing you a check for $35, $40, $50,000, and now you have it through technology available for what? Under $5,000, you could launch a fund or a syndication with all the documentation and all the filings, Form D and the Blue Sky. From what I understand, it all is included for $5,000, which is a ridiculously good price.
Filings are separate, right? Because those are state by state and government, municipality by municipality. So people are responsible for just the actual costs of whatever those are. So the $49.50 for fund builder includes the setup, all of the documents, a profile listing on our site, a listing on the opportunity page, right? Which is effectively a marketing site for the manager to be able to use with their investors. And then there's an ongoing quarterly cost, which then we perform the administrative work to produce the financial statements on a quarterly basis after the fact. Right now, Mike, it only does individual single asset syndications. We're working on the pooled investment fund product. That should be ready sometime this summer, if all goes well. But we still have our offline advisory work where we'll help people. And that is greatly streamlined from what back when we did your first fund, which is probably going on 8 or 9 years now, right? So we've made incremental improvements over time, and now we're really taking a technology first approach to the whole process to automate it as much as we possibly can.
Yeah, and that's great. And I think most folks need a syndication, especially a single deal syndications. They happen every day, left and right, and nothing wrong with attorneys. They're wonderful attorneys, but they do cost a bit more than this, sometimes a lot more than that. So it's a way to launch new smaller deals rather quickly. I'm sure in a big syndication, folks may still decide to go with an attorney.
Oh yeah, and Mike, we encourage people, and we strongly recommend that people have counsel involved. But we've also, of course, hired counsel to consult and advise and draft all of the documents that we use. Different people have their own counsel. We have arrangements or relationships with multiple counsel who have blessed the documents that we're happy to refer people to, so we can certainly help grease the skids there. I think people still want counsel to represent them, but they don't necessarily need counsel on the front end to provide the sort of business advice and guidance on how to set it up, what kind of fees you might charge, what the structure is, how it matches the asset model. That's where the real value is, in my judgment. And I think, speaking from your own experience, I know that, you've been able to support that, opinion.
Yeah, it makes sense. So what I really like about the tool is also the fact that it's going to be all set up within the VeriVest platform. As folks launch their syndication and they need to do fund administration or syndication administration, it becomes essentially ready on the VeriVest for a very fluid transition from the launch into the
raise process, right? And I would say a big part of the value is also that it includes a profile page on the site where it has all the information about the manager, their company, the principals, their story, and it has an opportunity page that includes specific information about the opportunity that an investor can see. So it also obviates the need for somebody to prepare their own marketing material, PowerPoints, websites, right? So it's kind of an all-in-one tool. It's not just the documents and the setup. It's also the marketing materials that are necessary to be able to communicate with their investors.
And I think that's very helpful. The marketing materials are critical. As a fund is a vehicle, syndication is a vehicle. You still need to have the marketing engine to be able to get the message out. So that's absolutely awesome. So let's now switch and continue the conversation, talk about some recent events. We're recording this on March 14th. It'll go out fairly soon, but we've had, I don't know how else to put it, an exciting last few days. It's been not necessarily from a good point of view, but a couple of banks failed, and it feels nerve-wracking. Number of banks look like, at least regional banks, that there are concerns, and some of it is coming from the Fed too fast and too furious action, raising interest rates to curb the inflation. And undesired side effect was that many banks buy these treasuries, and they didn't realize what happens to these long duration treasuries when the interest rates spike. The treasuries fall in their value. It's supposed to be safe, but it's not.
Yeah, it's amazing how fast it happens, isn't it? I mean, banking is the ultimate confidence game, right? And when people lose confidence in a bank and there's a run and they're forced to sell assets in order to meet deposits, it can happen extremely quickly. But in my judgment, Mike, you're right. This is a direct result of the historically rapidly increasing interest rates and unaffected or undesired side consequences to the Fed attempting to rein in inflation. Now, I read this morning in the Wall Street Journal that inflation numbers are down again, which is not a big surprise if you look at a big portion of what is measured in the inflation indexes are rents, which but they lag by 5-6 months. So the fact that they have been dropping, you're just now starting to see it. So well, it'll be interesting to see what the Fed does here at their next meeting, and whether they go through with another aggressive round of increases, or if they back off, or even pause momentarily. It'll be interesting to see.
Yeah, we don't know. That information will come out soon, but certainly the recent events should give them at least a reason to consider slowing down. And there's the term that the Fed action has long and variable legs. So the action now will not be seen for another 6 months. It's almost to the point that they've done enough. They've done enough, and whether they stop now or they push it a little bit more, the damage has been done. And we talked about this, that a lot of real estate deals that kind of went into life a few years back before the rates went up now might face challenges. It actually came up at the conference. It's almost shocking what percentage of the deals, of the value add deals, were financed with bridge debt. If you think about it, virtually all of them.
Well, yeah, I mean, by definition, right, a value add deal implies, that there's something to be done to get the property from where it is today to some future state. And in those instances, unless you're putting down massive amounts of equity, far more than most sponsors are willing to do, you can't get fixed rate debt. It's variable rate debt. You can put a cap on it, right? But if you look at the forward curves of what the expectations have been over the last 6 months or a year, and you bought you were going to try to pay for a cap, most people concluded those caps weren't worth the price. Well, they certainly were with the benefit of hindsight, right? But hindsight's 20/20. So yeah, I think that we're out looking on some of the deals at Fairway. We've been talking with some very active debt shops, and the consensus is from these are guys my age that have been in the business a long time, Mike. I mean, and it is some of the wildest, craziest debt markets any of these people have ever seen, right? I mean, debt quotes are 6, 7, 800 over SOFR. I mean, you're looking at 10, 11, 12, 13% interest rates for bridge debt. I mean, it's hard to even fathom, how fast all of this has been thrust upon real estate people in the last 6-9 months.
Yeah, it's a great point. Well, the volatility is up. That spread goes up substantially when the volatility and uncertainty is up, and we are living in the period of increased uncertainty and increased concern of what's going to happen. And of course, the spreads are gigantic. So maybe that's why the new deal flow kind of all froze.
Of course. And even, we're seeing, we have a large deal that we're in where the deal itself is going great. I mean, we're ahead of schedule on basically every metric on the execution of the business plan, but the lender is having problems behind the scene, with their own, financing structure, and they can't fund and they won't fund. And of course, they're making all kinds of excuses. and reasons why they're not funding and trying to point to the loan documents. But at the end of the day, they don't have the money. So now you've got a situation where, how do you, you're talking millions and millions of dollars of operating reserves, paying utility bills, paying contractors, paying interest reserves of all the money that's sitting there that you can't get access to. So, and then they threatening to put you into default if you don't come in and rebalance the loan with millions of dollars of additional equity that you don't really even need. It's this kind of stuff is happening out in the marketplace. And, it's, I haven't seen times or situations like this since the Great Recession, so it's, it's serious out there right now.
Yeah, man. And that's a great point that some of these banks actually don't want to even advance the cash they're committed to advancing.
Well, it's not even that they don't want to, Mike, in a lot of cases, and they're not banks, right? These are debt funds, right? Large debt funds that have raised capital through, whether they're individual high net worth investors or institutional groups, and have leverage, from banks on those lines. It's like they fly, because some of that, the commitments they make to invest in construction draws in the future are predicated on models that anticipate payoffs happening in historical patterns, right? Well, all of a sudden, payoffs are not happening. So you might expect, for example, 30 or 40% of your portfolio in any given quarter or year to pay off, right? And you would recycle that money to meet contractual obligations for future funding on construction projects. But if all of a sudden that goes to 0 or 5 or 10% instead of 40, where do you get the money to fund those commitments? Right?
Yeah, it is. You're absolutely right. The pattern broke. Whatever used to work for a long time broke. And I guess you can't blame Fed for everything, but they kept things steady at the reserve policy for a long time, got everyone accustomed and used to certain standards and certain behaviors. And then they moved things up too fast and too furious. And that's breaking the system up. The system is destabilized. And we're still yet to see what consequences. And even these lenders are not necessarily banks, but they are impacted in some other ways. Like you said, the payoffs are not coming in, probably fresh money, harder to raise. And they were relying on banks. The banks may be freezing some of their lines of credit.
You raise new money, you're out of covenant with your underlying bank lender that you use to leverage the funds, right? New investors aren't making commitments because they're worried about existing assets. Payoffs aren't coming in, and all of a sudden, when money's not flowing anymore, right, things start breaking down. And you're seeing that across the real estate landscape, and it's it's scary for people. I mean, there's going to be some pain. We'll see what the Fed does. I mean, it just continuing on raising rates, it just seems like idiotic policy to me. But I'm not the Fed chairman, so.
Yeah, that's the crazy part. They're obviously brilliant folks, but most of them are kind of academics. They're professors. They're scholars. They're not necessarily business people. And in theory, all this stuff sounds great as a way to fight inflation. In practice, they're causing problems that they won't see for a long time. And they're supposed to be data driven, and often the data they get is in their ears. So. Yeah, let's hope at least the 10-year Treasury last couple of days. Well, the entire yield curve, all spectrums of the yield curve over the last few days after the SVB bank and the Signature Bank collapse, has the yields have dropped substantially in a very short amount of time as the market is fleeing to safety. But that's another crazy side effect. What's going to happen with a number of these regional banks whose balance sheets are substantially impacted, and there's a concern. There's a flight to safety to these large, let's just call it, I don't know if they're big 5 banks, but the large banks are probably seeing inflow of cash. The question is where the cash is going to go. But the small banks are going to bleed, and a lot of economy is driven by the relationship with the smaller banks.
Yep.
So it's going to be interesting, hopefully not in a really bad way.
Yeah, I mean, one would think that you might see the Fed, at least take a pause on this next round just to let everybody catch their breath, right? But what do I know?
Yeah, we shall see. The news will come out fairly soon. What do you see happening the rest of the year? Actually, it came out of the conference. There's a lot of maturing debt, a lot of bridge debt maturing, rate cap expirations. How most of these real estate projects going to survive? They're going to need to raise more equity capital. They're going to need to raise fresh capital, capital calls. Are they going to go get some bridge debt to keep them afloat? Just curious, because the project itself may be doing phenomenally, executing on a plan really well. But if the maturity loan matures, what do you do?
Yeah, well, I would say my historical experience in all these years is that debt is kind of the number one variable that causes the most pain for people. Um, it just is. So I think people. To answer your question, I think it's a combination of all of the above, and it's very situation specific, right? It's going to be asset by asset, deal by deal, as to what people do to try to resolve the problem. And in some cases, the problem will not be resolvable, and there'll be serious pain, and equity will be lost. And in other cases, there might be solutions to it, whether that's pref equity or mezz or rescue capital that comes in a senior position. In which case the common, most likely takes a haircut on the outcome, depending on how long, it holds. If people have to refi, they're going to have to refi at higher levels, which probably means that things don't meet debt coverage, which means you got to buy it down, which means you got to bring in more equity. That either comes in from new, fresh capital with new people that are probably going to command a preferred position, or capital calls for existing investors if they want to protect that position. So it's just very deal and situation specific, in my opinion, Mike.
Yeah, that's a very it's a reality hit feedback. Unfortunately, the reality may be harsh in some situations, and it came out of the conference that there is a substantial number of these loans that are just not refinanceable in the current state of capital stack. So some loans will just not be possible to refinance without major cash infusion, and a lot of investors may not want to put good money after bad money. It's going to be
We'll see what happens. And then what does the lender do, right? It's like lenders, by and large, don't like taking property back, right? So if it happens in mass, then you get a lot of extend and pretend, like you used to, or maybe there's some blended solutions with lenders that go up higher in the stack and take a premium, on the tail 5, 10, 20% of the deal. I mean, but that's going to be lender specific, and some, might have the flexibility to get creative like that, and others aren't. So again, very deal and situation specific, depending on who what the asset situation is and who your counterparties are.
Do you see great opportunities for fresh money? Intuitively speaking, as more deals hit trouble, and the assets themselves may be fine, but the capital stack could be in trouble. The equity could be in trouble. Do you see workouts, better opportunities for fresh money to come in and distress financing, maybe new acquisitions at a discount? Just curious, what do you see coming?
It's hard to imagine that doesn't happen, but again, those people I think are going to be looking for pref positions, which will be to the detriment of existing common equity holders, most likely. And I think even people coming in pref, it's like, until things stabilize, how does anybody even know what level of risk they're taking by how far up in the stack they're going, right? Because if rates keep going up, you might think you're okay in the stack, but you're not if it keeps on going up. So my suspicion, Mike, I think in the short run, people keep doing what's happening right now, which is nobody's really doing anything. Everybody's trying to figure it out. And, we've underwritten a bunch of deals that we underwrote in December and January that we're supposed to close or in February or March, that by the time you get to this point, they don't even pencil anymore, right? Because the rates have shot up so much in that short period of time, and the availability of debt is gone, right? To the point where you have to re-underwrite the entire deal, and it makes no sense now. So without going and retrading your existing or your seller, deals are just not happening. Existing deals, I think what happens in every cycle like this is that everybody in the world has what they have, right? You've planted your garden with whatever, vegetables you've planted, and now your garden is your garden, right? You have it. Now you have to figure out how to make the most of that garden, right? How do you not lose crops? How do you produce something out of it, even if that production is less than you anticipated, right? You just have to try to do the very best you can to manage through whatever garden you have. And then at the same time, you say, okay, I've got some additional acreage over here. What else can I plant? What does it make sense to plant now based on what we think is going to happen going forward, which of course nobody knows for sure, and everybody's got a guess, or an opinion. So, people will plant new vegetables based on whatever they, believe the weather's going to do over the next year or two or three or five, depending on how long, the cycle is for that fruit to bear.
Yeah, that's a great analogy. Certainly, we all are focused on what we've got. And that's all we can control. We can't control future deals. We can't control what the Fed does.
Yeah, and even then, Mike, you can't even really control, all aspects of the stuff you already have, right? Because if interest rates keep going up, you got variable rate debt, or your lender, pulls the plug, or right. I mean, even the most competent, capable people are susceptible in times like this because, there's just certain things in life that are outside of people's control, no matter how careful, you've been heading in. So, I think all in all, if you apply fundamentals and you make good decisions, you generally come out better than those that didn't do that. Right. But the reality of the market when things are going extremely well is that if you're going to do any deals, right, you have to be reasonably competitive with what else is available in the market, or you'll never get a deal in the first place. I mean, I heard some guys talking at the BEC about how they apply, these super conservative assumptions across all elements of, the underwriting standards, and we model in 300 basis points higher cap rate on exit, and we model in 250 basis points higher interest rate than what we actually get, and okay, and then they do that 6 times over. I'm like, well, how do you ever close anything, right? So my point is that everybody's got mandates and goals and targets and objectives about the money they're trying to put out. And when you're in a competitive environment to acquire those assets in the first place, right, the assumptions that were made in order to acquire those assets all of a sudden, don't hold anymore. And now people have gardens they've planted that they're going to have to really, really attend to in order to be able to get any, fruits out of it.
Yeah, that's a great point. That people talk the talk, but walking the walk is very hard from the point of view that, in theory, those downside protection deals, great conservative underwriting, all sounds good in theory. In practice, if you do it systemically, you can never get any deals done. So most people try to get one of these really good deals, but majority of the deals trade where they trade. There's a market for those deals.
That's right. And
you can't get a perfect deal every time.
No, I mean, look, and you can certainly develop proprietary ways to find, everybody talks about an off-market deal, right? To find off-market stuff or to find things that are better than others. And I'm certainly not disputing that some people are better than that at others. But I'd say another thing that's happened in the last 10 or 15 years is with the proliferation of information on the internet and all these services that people provide, it's harder than it's ever been to find, a diamond in the rough, because everybody, there's more information than there's ever been to more people that it's ever had. So I'm still amazed if somebody goes in and finds some seller who's been sleeping under a rock and, has never heard of, Googling, what are apartments trading for in my market right now before I sell my 300 unit building, So I'd say by and large, people can be marginally better at finding, underpriced deals, but the what is the word? Like the variance from the mean is not that high, right? It's not 30 or 40 or 50%. It might be 2 or 3 or 5, maybe 10%, right? For the best of them. And even then, it's not every time. All of that means that there's just like, unless you have the people who are going to win the most, Mike, as is usually the case, the people with the most money, right? And the most cash, because if you're low levered or you have no debt on your assets, your balance sheet might go down, but you can hang on in debt forever because you don't have to worry about the debt, right? It's the folks, and I know a fair number of family offices that we deal with, right? And they're, right now they're just picking the litter, right? Because everybody needs money. And, there's a lot fewer people giving money. So the people with all the money are, commanding, very attractive terms in today's market, right?
Yeah, that's a great point. Cash is the king at the end of the day, especially in this environment when it's going to be a buyer's market. Folks who can bring the cash will command better terms as the deal's going to be a lot fewer to take place, a lot more selective. So it makes a lot of sense. So any other parting thoughts? We are out of time, but any great fresh book recommendation, any other idea, or how would folks reach out to look at the fund builder? Is that great? VeriVest.com, I assume.
Yeah, I'd say, my parting thought, Mike, is I guess, I've always been a more optimist than a pessimist, right? And I think that out of every adversity comes great opportunity, right? It may not feel like it at the time, but it does. So, some of it is just, having a belief system that you keep your eyes out for the opportunity, right? You protect yourself as best you can so that when things like this happen, you can survive and make it through and take advantage of those opportunities, but there's always opportunities. So, people can reach me. I'm on LinkedIn, pretty active there. FairwayAmerica.com or VeriVest.com is the two companies, and my email address is the same at both. It's first name dot last name at either Fairway America or VeriVest.com. Matt.Burk at FairwayAmerica.com.
Matt, thank you kindly. Love your parting thoughts. It's a state of mind. And I remember this expression reinforcing what you just said. A pessimist sees a difficulty in every opportunity, and an optimist sees an opportunity in every difficulty. So I'm also an optimist, and I share your thoughts, and I think some really interesting opportunities will be coming, and we'll persevere through this. There are worse things in life. We just move on, and bigger and better things will happen. Let's just keep a great state of mind. So thank you for coming on the podcast.
Thanks for having me, Mike. Anytime. Appreciate it.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.